Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, big tech earnings leading stocks higher. We'll have full coverage ahead. Plus, we'll dig into energy earnings as well. Chevron and Exxon topping Wall Street estimates. And YouTube and Disney reaching a stalemate. Will they reach deal by midnight? We'll discuss that and more on Market Catalyst. Let's take a look at the major averages to kick things off here. We are seeing a rally, although there's a pretty big range over the major averages in terms of the size of that rally. For the Dow, it's up about 41 points right now, so relatively small gains. The S&P 500 up about 0.4%. It's really the Nasdaq dominating today, up 0.9%. And to look at why, take a look at the Nasdaq 100 and the big movers here. Interestingly, Apple, which of course reported numbers that beat estimates and said it expects a record for iPhone sales in the fourth quarter. Those shares are now down about 0.4%. But Amazon accounting for a lot of the gains here. It's up 11.5% after its AWS growth beat estimates. Also should note Nvidia shares, those are rising 1.1% here today and recovering some of the losses that they had up about 2% over the past few days. And let's just for the fun of it check on the market cap. It's back below 5 trillion, hasn't peaked above that level once again. So you are seeing a decent number of movers to the upside here based upon earnings news. By the way, another one that caught my eye here is Strategy. Those shares are higher after that. Mostly Bitcoin treasury company, but a little bit enterprise software on the side. Those shares are up by 6% after it reported its numbers. On the sector basis here, as we take a look under the hood of the S&P 500, utilities, consumer staples, materials are down. Consumer discretionary, Amazon is in this sector, by the way. It's not in the tech sector. It's in XOY. And so that's why that group's up so much. And then you got energy being helped by Chevron in particular. That group is up about 1.1%. Let's talk more about Apple now. It is wrapping up a solid quarter and issuing upbeat guidance with what Tim Cook is saying the December quarter will be the best ever for iPhone sales. Joining us now for his take on Apple's results, Brandon Nispel, KeyBanc Capital Markets Equity Research Analyst. Brandon, thanks for being here. I actually want to start with the stock reaction because we just checked on it. The shares are dipping a little bit now. What do you make of that action and kind of the reaction that we're seeing to the numbers?
Yeah, I mean, I think the stock reaction is a reflection of, how well the stock has done going into results. I think a lot of investors were really expecting Apple to provide really strong guidance. All the reports were indicating that iPhone sales would really be strong and guidance would be strong from Apple as well. I think the dip, though, is really a function of probably more around the gross margin guidance, which came in a little bit seasonally lower. And then notably on the OPEX, Apple's planning to really increase its operating expense level going into their fiscal first quarter. And they really called out accelerated investments in AI. And for any investors that are really focused on earnings per share, I think that's going to have an impact.
Going to have an impact because of that increased spending they're doing?
Increased spending, which probably would take down consensus estimates a little bit, yes.
Do you think, do they have a choice at this point, right? Is it kind of non-negotiable that this is what they have to do?
No, I think, all investors want to see from Apple is some type of AI strategy. That I think that's definitely fair. I think one thing that still remains to be seen from Apple is what that strategy is and how they really plan to monetize AI. From our perspective, what we've seen from consumer research and consumer surveys that we've done is, consumers aren't really interested in upgrading iPhones from Apple Intelligence and just different software upgrades. And frankly, in the last couple of years we've done the survey, there's sort of some waning interest in terms of paying for Apple Intelligence. And so we really need to see something come from Apple quickly, and that something needs to be sort of like really differentiated because you're starting to see a proliferation of free AI different apps in the market like ChatGPT.
Brandon, just to dig into, what we need from Apple a little bit more, as our tech editor Dan Halley pointed out before, like Apple is not like the AWSs and Alphabets and Microsofts of the world. It's not a hyperscaler, right? It's a consumer-facing company rather than primarily a cloud or enterprise-facing one. And so, like, why can't you just go on your phone and use ChatGPT through the phone, right? Is it just the idea that Apple, by not coming out with its own version, is leaving money on the table? What's the thinking around all of that?
Yeah, I think, again, investors want to see some form of Apple intelligence that they actually can monetize it. I think it's hard for investors to see, some third-party app that you can utilize on an Apple iPhone that Apple is going to be able to monetize. Now, there's different ways that Apple could integrate ChatGPT. Maybe it's into search, right? Maybe there's some sort of search partnership in a similar way that they've done with Google in the past. So there's different areas that I think investors are thinking, and probably Apple's thinking that there's ways to monetize. But just integrating a third-party app that's generally free is not going to be one that Apple is going to be able to monetize.
In the meantime, their existing business is a monster, right? And they're expecting that the fourth quarter sales of iPhones to be a record. But also, we should mention the services business crossed over $100 billion alone in its last fiscal year.
Right.
So it's not like Apple is suffering as it is. But how are you thinking about the sort of different parts of the business?
Yeah, look, iPhone definitely went through an inflection. I think there's sort of broad-based demand. I think, one of the interesting things that Apple called out is that there's supply constraints. So growth could even be better. From our perspective, as we look forward, though, that actually is going to create a little bit of a headwind. You're going to have really difficult comparisons trying to grow on top of, the guided double-digit iPhone growth for this upcoming December quarter. In reality, Apple's growth should really be framed in the context of what, increase in penetration of smartphones is, which is a mature market. So it should be low single digits. So it will create, different comparability issues going into next year. In terms of services, our perspective has always been Apple's done a really good job of growing the base of iPhone users, and ultimately those base of users use their services. And so long as the base is growing, that services line is growing, and Apple has done a good job of expanding the offering of services over time. And I don't really see anything changing that. I think there's been some concerns over the last couple of quarters that services growth would decelerate towards, a high single digit rate. We obviously saw that tick up towards, mid-teens. It was 15% last quarter. And guidance expects it to continue to be very healthy in the teens. And I don't really see that changing.
Hey, Brandon, a quick question about tariffs. So costs are going to tick up for tariffs this quarter a little bit. Does the outlook for tariffs look a little better given some of the truce headlines that we got this week between the U.S. and China?
Oh, absolutely. I mean, I think if we went back a couple of months ago, the outlook got better very, very, very quickly relative to where it could have been. So Apple, I think in their December quarter only expects an incremental $300 million of tariff cost headwind. They guided to a $1.4 billion in tariff costs in the December quarter versus tariff costs of $1.1 billion in September, even though their sales are going to be up pretty meaningfully in the December quarter. So it's pretty de minimis type of impact. And I think tariffs in terms of an impact on Apple are long behind us at this point in terms of a negative implication.
Gotcha. Brandon, thank you so much. Appreciate it.
Thanks for having me.
Well, Disney is pulling its content from YouTube TV as the two companies fail to agree on a new carriage deal. Joining now with the details is Ali Canal. So, Ali, we got used to these sort of carriage arguments with the cable world. Mm-hmm. Now we're bringing it to streaming.
Bringing it to streaming just goes to show the economics are changing. A little spooky if you're a Disney fan and a YouTube TV subscriber. How to get in there? It's Friday. Happy Halloween. But the two sides failing to reach that new carriage agreement before the midnight deadline. So subscribers losing refusing access to channels like ABC, ESPN. Last night, it really happened about a half hour early, around 11:30 p.m. So that means if it heads into the weekend, those consumers and subscribers are not going to be able to access NFL, NBA games, or those college day games. Now, at the heart of the dispute is what else? Money. Disney is pushing for higher carriage fees, while Alphabet's YouTube TV says it won't agree to what it calls unreasonable price hikes. YouTube is saying that it will offer subscribers a one-time $20 credit if Disney channels stay offline for an extended period of time. They didn't necessarily say exactly what that time frame would be. My guess it would be through the end of the weekend. YouTube TV also encouraged folks to sign up directly for ESPN in the meantime, which I thought was interesting. But in a statement, Disney did argue that YouTube TV, which has roughly 10 million subscribers, is refusing to pay fair market level rates that other distributors like Comcast and Charter have already agreed to. And then YouTube TV fired back and accused Disney of using blackout threats to pressure negotiations while benefiting its own streaming bundles. And that includes Hulu plus Live TV, which, as we know, is a competitor to YouTube TV. So just the latest in a string of these high profile battles. Yeah. Disney has been in quite a few of these blackouts before with Charter, DirecTV, others. And really it just coincides with the rising cost of sports. And then at the same time, the changing economics within the TV viewing landscape at large.
Yeah, and the distribution channels may be different, but the rhetorical playbook remains the same.
You still got to watch your shows somewhere and access your content, but I think it will get resolved.
Eventually soon. They'll figure it out. All right, let's talk about other streaming headlines as well, because Reuters is reporting that Netflix might indeed be interested in Warner Brothers Discovery, but only parts of it, at the same time that Netflix is announcing a stock split.
Right, and this is something that got brought up on the Netflix earnings call. Co-CEO Ted Sarandos, he made it very clear that Netflix was not interested in owning linear networks. So that would be those local affiliate channels that WBD owns. But it did, I was curious whether or not they would be interested in the studio side of the business. And clearly from this Reuters reporting, they are. And that means that IP access, things like Harry Potter. I'm sure Netflix would love to bring some of that programming onto the platform. However, it's going to come down to what Warner Brothers Discovery wants. So David Zaslav has continuously said he's going to make decisions that benefit all the shareholders. Does that mean selling the company in parts, or does that mean going all in and selling it all together? And Paramount Skydance has been interested in all of it. But they've also reportedly been denied 3 times by WBD.
Because the price, according to Zaslav, was not high enough.
Yeah, so it's going to come down to pricing. I think the timing is right with interest rates coming down a little bit. There's obviously a lot of money flowing from some of these big tech players, Netflix in particular. So we'll have to wait and see. But clearly a big shakeup and potential Hollywood bidding war on our hands.
Yeah, fun stuff.
Fun stuff.
All right, thanks, Sally. Appreciate it. Well, coming up next, earnings from Chevron and Exxon give a read on the energy sector, plus what sets Coinbase apart as the exchange makes a play for more institutional investors. We'll be right back. Coinbase on the rise after it reported earnings Thursday that topped Wall Street expectations. Consumer trading volume rose by 37% from the past quarter to $59 billion. And the company highlighted that its acquisition of Deribit is growing its institutional business as well. For more on what's next for Coinbase, let's bring in Devin Ryan, Citizens Director of Financial Technology Research, here with me on set. So Devin, just sort of big picture here, what did you make of the numbers?
So first off, Julie, great to be here and to see you here on Halloween. Great quarter. They beat expectations. I think kind of top line, expenses were in line, and then EBITDA was in line. But it's kind of coming twofold. One, the transaction activity is great, and they gave a pretty good outlook last night. But then also the bigger story is subscription and services, which is the USDC stablecoin revenue, some of the other kind of partnerships that they're bringing online, and we're seeing really good growth there as well. So I would say good quarter, but I think the update from last night was actually more important just around the trajectory of the business and all the enthusiasm.
Yeah, let's talk a little bit more about that, because our executive editor, Brian Sazzi, spoke with the CFO, Alicia Haas, about the company's play for institutional investors in particular. And we're going to play what she had to say, and then we'll talk about it.
Great.
We rolled out this new white glove service offering that's seen a lot of traction, and we're able to retain and grow these advanced traders on our platform. However, another bright star was we closed the Deribit acquisition. So our institutional trading revenues, they grew over 120% in the quarter. 120% growth. Phenomenal growth.
I mean, I guess that's in part because they went from very little to then buying this thing that caters in part to those institutional customers. But I think of Coinbase as mostly a consumer-facing or retail-facing organization, but I guess increasingly that's not the case.
Yeah, so on the trading side, the majority of volumes actually come from derivatives, so options and futures, and that's been an area that Coinbase has really accelerated growth over the last year, and then this Deribit exchange kind of step function that as well. So they're absolutely leaning in there, and then building really the infrastructure around that. So that's lending and custody and other things that institutions are going to demand, and so I think they're really well set up to participate in that. But then more broadly, this theme of bringing other companies on chain, whether it's through stable coins or I think the big story or the biggest story with Coinbase is the everything exchange, where really using the plumbing of digital assets to bring other asset classes on chain. So it's everything crypto, but then every other asset's going to get tokenized over the long term, and Coinbase is going to be in the middle of all that. So traditional financial services is coming towards crypto, and I think Coinbase is really well positioned for that theme.
Interesting. So the tokenization of everything can sit on Coinbase, and that's where it can eventually be traded.
Exactly, and that's we're literally at the starting line of that, and we're waiting for. We just got the Genius Act passage, which is unlocking stablecoins, but the Clarity Act, which is either late this year or early next year, is going to ignite this theme of tokenizing everything, and that to me is that's why you look at Coinbase today and buy the stock, and they're just uniquely positioned to be able to execute on that because of their history in the space. And this is a really technical space that people can't just build or bring a few engineers in to get into.
Well, to that point too, though, I was reading a little other analyst commentary that talked about costs ticking up as a result of this, that they're investing in all of this. So what is that going to mean for investors going forward?
Yeah, so that's the great question, because we're in this tough balance right now of there's so much growth ahead, there's so many areas, and you want to maintain that lead, but at the same time, investors demand some operating leverage here as well. They are showing operating leverage, and actually they talked about last night, they've had really big headcount growth in 2025. They're going to absorb some of that into 2026. So I think next year, as a lot of these growth initiatives kick in, as you're kind of flattening out on headcount growth, that should be good for costs. So that's one point. Then the other piece is M&A, and using M&A as a tool here to kind of accelerate growth. There's rumors of some additional acquisitions that they're looking at, and I think that's going to be another big tool for them to drive growth, but then also integrate these companies and get some operating leverage as well.
So I'm curious, and you sort of have talked around this this issue, is when I think of these exchanges, especially the ones that are sort of crypto native or heavily crypto, what's differentiating them from a competitive perspective? So I think about Coinbase, I think about Robinhood, I think about Kraken and Binance and all of those exchanges.
Yeah.
What's if I'm trying to figure out where to trade, if I'm either a consumer or an institution, what's the difference between one and another?
Yeah, another great question. So I've covered brokerages and exchanges for 20 years, and price matters to some people. So price, you have to make sure you give the best price to the people where it matters the most. Some people care more about experience and all the other aspects that you give them in that relationship. And so I think for Coinbase to maintain its leadership, it's about building out all these other capabilities. So it's building out financing and prime brokerage and the tools of being this institutional hub. But then also for consumers, what else can they connect you to? Can you use the wallet to go buy things? Can you connect in with other merchants? What are the value add services that they are bringing in? So the buying and selling is really a commodity, right? Anyone can push a button and buy and sell, but what are the other services that you can add around that? And that's what you can monetize, and that's what creates that sticky customer relationship. And so I think they're way ahead on a lot of those areas. It's not just about trading, it's about this other infrastructure that's being put in place. And that's why they're spending money to maintain that lead.
I mean, the other question all of this begs is how risky is it? We saw what happened with crypto, what was it earlier in October when you had the crash, because everything is so leveraged, particularly the non-Bitcoin coins, right? And so, if they're offering all these other products, how worried should we be about that risk?
Well, so I think where we are right now is we're transitioning from a moment of primarily speculation. This industry was built on speculation, primarily because you weren't able to use the blockchains, right? And now we're moving to pretty rapid step function in mainstream use cases. Stable coins is the first really use case at scale, scaling rapidly. But then once we get this regulation and legislation on tokenization, you progress towards more traditional financial services. And so my view is that a lot of the excess speculation and some of the meme coin craziness, and there's tens of thousands of cryptocurrencies out there, there doesn't need to be tens of thousands. There's going to be a small number of blockchains where activity coalesces around, they build network effects, and those tokens could have more value than today if people are really using those blockchains. But we're at the front end of that step function in using Ethereum or Solana or Sui or some of these, Avalanche, these layer one blockchains. And that to me is what gets, is really exciting about this. And I think that reduces the volatility, reduces the speculative aspect of what really the industry was built on, because that was all that was really allowed.
Right. Devin, such interesting stuff. I know we're going to keep talking about it. Thanks so much for coming in.
Good to see you, Julie.
Appreciate it.
Yeah.
You too. All right, let's switch gears and talk energy, shall we? Chevron and Exxon are also out with their third quarter results. Chevron is climbing after it topped expectations and reported record production. Exxon also beat estimates, but acquisitions in the third quarter weighed on free cash flow. Joining me now, Fernando Valle, Hedgeye Risk Management Energy Analyst. Fernando, what's notable to me in both of these cases is that even with oil prices trending lower, these companies do not really seem to be slowing down production. What do you make of that strategy?
Well, I think more than just not slowing down production, they're actually acquiring more and more reserves. You saw obviously with Hess, the acquisition that Chevron made in this year. And then you mentioned Exxon spending $2.4 billion in acquisition. And to us, it's really about hoarding the resources and capitalizing on scarcity value at the current low prices. You can acquire those scarce resources, the top tier resources like Hess, like Pioneer Natural Resources that Exxon acquired at a relatively low cost, and then preparing for essentially an upturn in the next 2 to 3 years, maybe 3 to 5 years, depending on your time scale. So these CEOs make decisions thinking on 5 to 10 years as opposed to the current oil price.
So let's zero in. We're showing Chevron. Let's zero in on Exxon a little bit more here because of that free cash flow pressure. It sounds like you think that this is the right strategy, that Exxon is taking the right tack, that the company made these acquisitions. Do you think they should and will continue to make those kinds of bolt-on acquisitions?
I think they will, and likely they should. The question is obviously deal by deal, but when you consider WTI under $60 a barrel, and there are a lot of distressed sellers there, and the leverage in both Exxon and Chevron's portfolios is relatively de minimis. They are less than 0.5 times net debt to EBITDA if you annualize the third quarter EBITDA. Chevron slightly higher, 0.7 times net debt to EBITDA. So there's plenty of room to both continue buybacks and to make these acquisitions. I don't see a huge pressure on them today to either increase their distributions. They already distributed almost $10 billion just this quarter. So hoarding those resources again, in a scenario where shale is plateauing, and that was a comment by Exxon CEO. It's something that's been echoed by Diamondback CEO and others within the industry, and we agree with. You're better off getting those scarce top tier assets now, and then hoping that as the world absorbs more of this OPEC plus supply and benefits from this low oil price on the benefits that it gets on inflation, that you get an uptick in the next couple of years that will warrant these acquisitions.
And speaking of acquisitions as well, we got to talk about Chevron and Hess, because this is the first quarter where you're really seeing that Hess benefit, and that boosted Chevron's production by 21% here. Chevron is taking a little bit more of a cost-cutting tack than Exxon is, it seems. So what do you think of that approach amidst this backdrop?
Well, I think what's interesting is that the portfolios are converging to be very, very similar. What Hess brings is exposure to Guyana, where Exxon is actually the operator, and they bring some more. They bring some Bakken and some smaller assets, but the main asset, the crown jewel, is Guyana, which is what they fought about in court or arbitration court to settle the Hess acquisition. So when you look at what Hess represents to Chevron, is really an asset deal. They were going after that 30% stake in the Stabroek block. So cost reduction within Hess is going to be pretty stringent. They were trying to buy that asset. It's a non-operated asset, meaning most of the costs of running the field fall on Exxon. They're split after, but the overhead falls more on Exxon. So there's no reason to have a huge doubling of the overhead between Chevron and Hess. So there will be very significant cost cuts there.
Do you think both of these stocks are good buys here, Fernando?
We tend to like both of them because the portfolios are increasingly moving towards the low end of the cost curve. We think Guyana is probably the best project out there, and now both of them have exposure to Guyana. Exxon probably has a superior Permian basin to Chevron after the Pioneer acquisition, but they're both have a decent growth profile in the Permian itself. Where we think there's a differentiation is on the LNG side, where Exxon has better legacy and new build LNG. And then on the refining side, the refining part for Exxon, which is integrated with its chemicals business, it's also superior to Chevron. So there's a discrepancy potentially on valuation today. But overall, we think the asset base, we like Exxon's better than Chevron's.
And then just a quick follow on this, Fernando, because both of these stocks have underperformed the market, right? Do oil prices, how long do investors have to wait and to see, maybe a recovery, more of a recovery in the shares? Do they have to wait for the oil price to inflect higher?
Yes, I think ultimately that's the biggest hurdle right now, not just the oil price, but the natural gas price as well. And I think we are right ahead of a huge shift in energy demand, right? We all talk about AI. The previous guest was just talking about Bitcoin and other cryptocurrencies. These are all massive energy demand centers. So if we continue to grow on both of these, the natural gas demand is going to be very significant. The construction of infrastructure will also demand a lot of petroleum, from diesel to build these roads and facilities, to mine all the copper and other elements that go into building out the infrastructure that we'll need to supply data centers, to supply cryptocurrencies, and just hopefully also other growth, global growth that will resume over the next couple of years.
Fernando, good to see you. Thanks for joining us.
My pleasure.
And you can tune in at 3 p.m. Eastern today for my interview with Chevron CFO, all about these results and what is coming next. You don't want to miss that. We've got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Walmart is out with new AI tools on its app ahead of the holiday shopping season. Yahoo Finance got an exclusive first look. Senior reporter Brooke DePalma joins us now with the details. Brooke, what do they have cooking?
Good morning, Julie. Well, certainly what we know is that this announcement comes after that key partnership with OpenAI, but this technology that they announced today was developed internally at Walmart. And it comes as Walmart has always tried to create this quote unquote omni-channel experience, blending what consumers see online, especially within that Walmart app, and also in store. And in fact, they say that when customers use the Walmart app within the in-store shopping experience, they tend to spend about 29% more. And so these latest AI tools really lean into that idea. The first thing is they now have that Sparky, that AI chatbot. Well, now it can create an automated shopping list for consumers and also show consumers the best route around the store for that, holiday shopping time, maybe if you're throwing a party of some sorts. But Walmart Chief Technology Officer telling Yahoo Finance that you could specify a very high level goal, as you could see on your screen, like you want to plan a New Year's Eve party. And then he said something interesting. He said that Sparky is going to understand everything about you, from your past purchases to this party that you're planning, and then create that list moving forward. And other technologies that they're also introducing is this interactive store map that will show consumers those in-store saving deals, and also just really improve that more precise location. So say if you're trying to find a certain toy and where it is in the aisle, now within the app, in that interactive store map, you could see that. But just to take a step back, all these announcements, all all these new AI tools on Walmart's app really come at a time where more and more consumers are thinking about using AI ahead of this holiday shopping season. Bank of America came out with a survey and they said that there's a few different ways that consumers are using AI this holiday shopping season. They said that Gen Z is going to use it the most at 71%. But as you can see in your screen, about 28% of consumers plan to compare prices or deals. They're also looking to get some gift ideas, and also they're looking to really track their spending. So perhaps putting in a budget and then trying to figure out the best items for who you need to shop for from there. And this is something that many sources have been telling me, even going back to the summer ahead of this holiday shopping season. KPMG saying specifically that AI is going to be a key companion for consumers this holiday season.
Now time for some of today's trending tickers. We are watching Reddit, AbbVie, and Western Digital. First up, we got Reddit reporting third quarter earnings that beat on the top and bottom line. Reddit also gave a better than expected forecast for fourth quarter sales. It's a sign that the company's advertising business could continue to grow at a steady pace. Reddit's capitalizing as well on its trove of user posts that have become valuable training data for AI companies. Reddit has data licensing deals with OpenAI and Google worth hundreds of millions of dollars. Next up, AbbVie. Those shares under pressure after reporting mixed sales for its drugs in the third quarter. Its beauty business weakened once again, underscoring struggles in its aesthetics division. Meanwhile, sales are booming for its new anti-inflammatory drugs. They helped fuel higher than expected revenue for the company, which led it to raise its annual forecast. And finally, Western Digital surging. The data storage company reporting better than expected quarterly earnings. It also reported new orders from its hyperscaler customers. The company's benefited from a spike in demand for hard disk drives driven by cloud computing and artificial intelligence. That demand has boosted both revenue and profit, and it doesn't appear to be going away anytime soon. The CEO said Western Digital's top 7 customers have provided purchase orders through at least the first half of next year. Meanwhile, one of its largest hyperscaler clients has signed an agreement through calendar year 2027. Western Digital is one of the best performers in the S&P this year. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're counting down to a big day here at Yahoo Finance. Invest on November 13th, starting at 8 a.m. Eastern. We've got a full day of live coverage of the key themes driving the market: AI, crypto, much more, with the top guests you'll want to hear from. We've got the biggest names, including Strategy Executive Chair Michael Saylor and Robinhood CEO Vlad Tenev. Among others, personal finance legend Susie Orman and the Shark Group CEO Damon John also will be joining us with tips to help you build your wealth. Don't miss it. Yahoo Finance Invest, November 13th. ServiceNow topping third quarter estimates with revenue up 22% year over year. The software company also raising its full year subscription revenue guidance on strong AI demand. Joining me now, Gina Mastantuono, ServiceNow president and CFO. Gina, it's great to see you. So stock trading a little bit higher here this morning on these numbers, the subscription revenue that you guys are talking about for this quarter of about $3.43 billion. So just talk to me about the demand drivers here and where you are seeing the demand going right now.
Thanks so much, Julie, for having me. Great to be here. So proud of the team for another spectacular quarter. Just incredible momentum, elite level execution, and most importantly, incredible customer impact. So yes, we were able to exceed both top line and bottom line metrics pretty handily, which allowed us to raise not only revenue for the full year, but also operating margin by 50 basis points and free cash flow by 200 basis points. And the demand drivers are clear. So our AI business is just doing phenomenally well. We're seeing real measurable results because our AI is built in and not bolted on. We're on pace to exceed $500 million this year in AI revenue, which is tracking well above our targets for $1 billion goal through 2026. We had 12 deals greater than $1 million in the quarter, including one over $10 million. We had AI Control Tower deal volume, which was 4x quarter over quarter. And this is because our AI business, we're able to connect any data model, any data source, and any cloud across the enterprise with trust, governance, security, and results at scale. Not only are we doing this for our customers, but we're also driving over $350 million of annualized value internally from AI productivity gains. We've invested a good chunk of that back into the business, into our growth initiatives, but we've also been able to drive more than 100 million to the bottom line just this year alone. So we're seeing real durable demand. It's not just hype here at ServiceNow.
Okay, so Gina, get a little more granular for me there, because how exactly, the products that you guys are using that have sort of the AI bolt-ons, how much more are you charging for this stuff? And what exactly is it doing for the enterprises that are using it?
Fantastic question. So as I said, it's actually not AI that's bolted on, it's built into the platform. And so we're using it across the enterprise. Ulta Beauty, a great customer of ours, is automating tons of manual tasks. Think about store management requests and store maintenance requests across 1,400 stores. AstraZeneca is deploying the AI control tower to manage and govern all of their AI initiatives at scale. And so we're really seeing such great progress. From a cost perspective, we continue to see about a 30% uplift for all of our AI products. So our customers are seeing the value, they're willing to pay for it because we're driving exceptional value for them across the board.
I'm so curious as well how you guys are using this internally and what it means also for, your sort of headcount. We definitely have seen some decreases related to AI in various parts of the tech industry. So talk to me how you guys are thinking about that.
So it's fantastic. So we're not reducing headcount, but we've absolutely been able to reduce our increases in headcount. So from the beginning of the year, when we came into 2025, the expected growth in headcount is significantly lower than originally planned. That's the 100 million of cost savings we were able to drop to the bottom line because we absolutely believe that there's a human element to AI. It's going to augment people, not replace them here at ServiceNow.
One of the other things that I know was a concern on the part of some analysts and investors going into the quarter was federal government spending. Obviously, the government is shut down. I know you guys talked a little bit about that on the call and, kind of what that could mean. Can you tell our viewers a little bit about that? How much of your sales are government contracts and what kind of visibility or not you have right now?
Well, our federal business is one of the strongest in the company. The team is just executing amidst pretty uncertain environment, and we had the strongest Q3 ever. So Q3 is always the largest quarter for our federal business, and we had the strongest Q3 ever. Our Fed business grew over 30% year over year, and that's driven by the modernization demand. We're really helping governments run like the best run businesses in the world. And so we're really excited. Demand is strong. The results in Q3 prove it. Certainly, the government shutdown right now might impact some deal timing in Q4. So we called that out specifically, but it's a timing issue only. Demand is really strong because we're really helping the government boost efficiencies by 30% across operations. And so again, durable demand, real confidence in that business and the opportunity going forward.
Gina, you guys approved a 5-for-1 stock split. Talk to me about the thinking behind that and whether this is, sort of aimed at retail investors and making ServiceNow's stock more maybe appealing to them.
Well, it's a great question. We're really excited about this. Our stock price has appreciated very significantly over the last several years. So this 5-for-1 split not only demonstrates the continued confidence in ServiceNow's growth trajectory, but absolutely it's greater perceived affordability and accessibility, not only for retail investors, but across the board.
And Gina, you mentioned the 5-year return of the stock. Year to date, ServiceNow, like other sort of large enterprise software companies, the stock has struggled a little bit on this perception that AI is going to come in and maybe replace some of the functionality that you guys bring to the enterprise. I'm sure you've heard these concerns. How have you been sort of addressing them with investors?
Well, listen, enterprise is so different than consumer. The need for secure, governed AI is so important. Workflows and business processes in the enterprise are so very complex. And so we keep continuing to outpace expectations, to beat expectations, because we're not going anywhere. Our products are exactly what our enterprise customers need. It's driving significant value. And we absolutely believe that AI is going to be a revolution in the enterprise. And we are so well positioned to capture that opportunity and to help our customers transform during what we think is going to be a generational shift in how work gets done in the enterprise.
Tomorrow is November 1st, and terrifyingly on this Halloween, that means 2026 is right around the corner. What does that mean for your money? Let's bring in our own Bob Powell, host of Yahoo Finance's Decoding Retirement podcast, for this week's FA Corner, brought to you by Capital Group, to tell us what moves you should make now to prepare your portfolio for next year. Bob, it's great to see you.
Great to see you too, Julie.
So
Glad to be here.
Let's talk about some of the tips that you have for folks. First of all, you got to look at your retirement accounts, you say, and maximize those contributions. How do you do that?
Well, walk down to your employee benefit department and check in on what you've been contributing and what you have contributed year to date. The contribution limits for 2025 are $23,500 for employees under age 50, $31,000 for those who are age 50 and older. And then this year, there's a special catch-up contribution for people who are 60 to 63. They can contribute up to $34,750. So if you're below those contribution limits, do all that you can to maybe increase the amount you're saving toward your retirement. And the good news is, that money goes in pre-tax. So that can lower your taxable income for 2025.
And do most people do this regularly, Bob?
I'd say they don't. Most people contribute, say, 6% of their own money, and the company chips in another 3%. So they're saving maybe 9% of their income. So if you're earning, say, $100,000, that's $9,000, and you're leaving a lot on the table if you have extra income. And for those people who might be expecting a bonus in 2025 and they receive it in 2026, this would be a good time to say, okay, well, I'm going to get some extra money. I'll cut into my current expenses to save a little bit more in anticipation of getting a bonus. So I'd say this November is a good time to sort of start looking at how much more you can contribute and get as close as possible to the contribution limits.
And then, Bob, the other thing that is governed by the calendar is, of course, open enrollment. And in particular this year, ACA, the Affordable Care Act enrollment, is going to be under even more scrutiny because we don't know what the subsidy situation is going to look like. So what do people need to be aware of when they are considering whether to enroll?
Yeah, so at the moment, the enhanced advanced premium tax credit goes away. So if you were receiving that in this current year, it's unlikely to continue. Your premiums are likely to increase next year if you're above the 150% of the federal poverty line. Expect that there'll be a lot of plans offered in your area. In some cases, there might be 100 plans offered. These plans range from bronze to platinum, and it really takes a lot of work to evaluate which plan is best for you. Don't focus on the premium if you're eligible for ACA and you anticipate enrolling in an ACA plan. Focus on the network. Are your doctors in the network, and worry less about the premium.
And what about things like whether to contribute to your HSA, for example?
Yeah, this is the HSA is called the Triple Tax Advantage account. The money goes in tax-free, it grows tax-free, it comes out tax-free if you use it for eligible medical expenses. Right now, the limits there are $4,300 for individuals and $8,550 for families. And the one bit of advice I would give people is try not to use your HSA for current medical expenses. It was designed to be an IRA for healthcare expenses in retirement. And if you are investing the money for retirement, don't invest in, say, a money market. Invest in something that will provide you with long-term growth, like a S&P 500 index fund or something like that.
All right, that's a really interesting point. Bob, thank you so much. Good to see you.
Thanks. Thank you, Julie.
That was FA Corner, brought to you by Capital Group. Coming up, we got full market coverage ahead in the second hour of Market Catalyst, including a conversation with the CEO of farm equipment maker AGCO. We'll be right back. minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets now. Taking a look at the major averages, we've got a rally across the board. It's strongest with the NASDAQ, which is up 1.2%. The S&P up about 0.6%. The Dow rising about 88 points, or about 0.2%. And as I mentioned, the NASDAQ is doing the best here today, and that has to do with what we are seeing in large cap tech. Of course, we have gotten a lot of announcements from 5 of the Magnificent 7 stocks this week, companies this week, reporting their numbers. 2 of them reported after the close yesterday. You're seeing them there, Apple and Amazon. Now, we talked to an analyst at the top of the 10 o'clock hour who said maybe there's some concern about margin pressure at Apple. Those shares are down right now, even though the company's outlook for iPhone sales in the fourth quarter is for a record number of sales, record amount of sales. And the company's services business is also firing on all cylinders at the moment. Amazon shares are up 11%, and that's as the company's Amazon Web Services revenue came in at a faster pace than had been anticipated. Amazon, like many of its competitors, is spending a lot. The combined spending announced this week, plans for the year, amounts to some $400 billion in capex that the hyperscalers are spending on increasing their computing capacity with an eye towards meeting AI demand. And of course, Amy Hood at Microsoft said, we're not going to meet it. We haven't met it. We're still going to have to continue to build here. So it's been an interesting week on that front. Let's also talk about Tesla, because it may be quietly steering back toward the mass market EV. Board Chair Robin Denholm saying the company's upcoming Cybercab, initially pitched as a fully autonomous robotaxi, could now launch with good old-fashioned steering wheels and pedals. That small tweak could be the key to unlocking something big, a cheaper Tesla, often called the Model 2. Here with more, Yahoo Finance's Pras Subramanian. So we had sort of given up on the cheap. I mean, there is a cheaper model that they rolled out, but it's not really like new and exciting.
Yeah, it's not the Model 2 or Model Q, as Deutsche Bank called, right? So basically, when Robin Denholm was asked about the Cybercab, and without pedals or steering wheel, it's extremely difficult to get approval from NHTSA, right? It's just not possible. You got to have those controls. So she said, you know what? If it needs a wheel, if it needs a pedals, we'll put that in there. It'll be fine. But the interesting takeaway from that is that, wait a sec, this is a $25,000, sub $30,000 car. Are you saying that basically we could have the cheap Tesla EV? Because yes, it is fully autonomous and would have the whatever the latest version of the robotaxi software would be, but also it could be driven, right? You could sell to people, and they were intending to sell it to people, and you could use it as a robotaxi whenever you didn't want to use it. So that's a way to get into that cheap EV, that market that many people would say that's needed for Tesla to maintain a, let's say, 20% growth rate from sales point of view. Yes, they had a great quarter last Q3 because of the expiration of the tax credit. That goes away. They announced the standard version of the Model Y and Model 3. Not that much cheaper.
And there wasn't a lot of excitement around it.
Not at all. No movement there. So this could be a way to get around that, and it's a kind of I think a missing sort of piece that people are talking about. Not just me, but people are talking about that.
And how realistic? I mean, was this just sort of floating the idea, or is this her saying that this is the likely, like when could we see this on the road?
So 2026 is when they want to do production of the Cybercab, and Tesla said that they are on schedule for that. So she had said that before, the Model Y, back when it was being sort of talked about internally, Elon Musk didn't want that to have wheels or pedals.
Right.
That obviously changed and became their best-selling vehicle. So you could see that Musk himself, for as mercurial as he is and sort of kind of hot-headed or hard-headed as he is, he's been known to change his mind in the past. And in the Isaacson book, he talked about how he saw a version of the Cybercab, a cheap EV, and he actually liked it. So maybe there's a wiggle room there that could wiggle room, I think, is the key point. There could be some possibility that's happening. We'll see. And
speaking of the mercurial CEO, there's an important vote next week, a shareholder vote on his new pay package, which both he and Denholm have sort of threatened that he might step away from Tesla if he doesn't get his money.
I mean, there's so many
and his control. In his words, the control is more important than the money.
Which is a whole other story. We can talk about that. But the one thing that I find interesting is that the chair, and now just today, Ashok Elaswamy, who's head of Autonomous on Twitter, I think yesterday, shareholders should approve Elon's package. Like, when have you seen the chair?
There was a huge lobbying campaign, in other words.
But internal, like the chair, management types in the company but going out publicly telling shareholders to approve this package is really weird. But anyway, that aside, November 6th is the day of the meeting. it seems that it's going to pass. This $1 trillion package will be approved by shareholders, believe it or not. But you have ISS and Glass Lewis saying, don't do this. And then also CalPERS yesterday, the big pension fund, said, we're not going to support this. So could that turn the tide? We're seeing big institutional investors saying no to that. We'll see, because right now that's what Denham was in New York last week, was to pitch the State Streets of the world, the Fidelities of the world.
Right. Please
approve this, because they manage so much Tesla stock.
Yeah, I was just trying to quickly look up to see what kind of share CalPERS has. I don't know that off the top of my head, and it's I'm not seeing it off the top of my head, but they're a huge.
Yeah, influential for sure, and it's something that's not a good look. But all sort of predictions show that it will get approved, and then there's going to be a lawsuit about that probably after that, so we'll see.
Most likely, but in the meantime, it'll placate Musk, most likely.
We'll see.
All right, looking forward to coverage of that next week. Thanks so much, Ross. Appreciate it. Coming up, I'll be speaking with the CEO of AGCO about the latest quarter and how trade is affecting the farming business. Be right back. AGCO, which designs and manufactures agricultural machinery and technology, reported earnings for the third quarter that topped estimates. Sales did decline from the same period a year ago as political instability and trade uncertainty continue to weigh on farmers. However, the company does expect a return to growth in 2026. AGCO CEO Eric Hansotia, Chairman and CEO, is joining me now. Eric, it's good to see you here. So talk to me about the quarter and kind of what you're seeing. We should remind viewers, you guys have a global business. It's not just here in the U.S. So talk to me about what you saw during the quarter.
Great to talk to you again, Julie. Yeah, I'm really proud of the team from this quarter. We beat our earnings estimate. We're controlling what we can control. It's a pretty dynamic environment in a couple ways. Number one, in our cyclical industry, we're essentially at the very bottom. We call it the trough. We're at the very bottom of the industry cycle. And we've been predicting that for a little while, and it's turning out to be the case. And so that means volumes are down globally just because demand is down. But we think we've found bottom now, and we expect some strengthening to come back into the market in 2026. Only about 20% of our sales are in North America. Our biggest market is Europe, and really outperformed in Europe this last quarter.
Yeah, I saw the growth there it was growing, first of all, but it was also growing double digits for you guys. What's driving the growth in Europe, and how is that market different from what we're seeing in other areas of the world?
In general, Europe is a much more stable marketplace. They have less cyclicality than other places. Brazil is the most volatile. Europe is the least, and that's largely because of the amount of subsidies that go into the farmers' pocket from the government subsidies. They're very forward-looking in terms of technology, and our big investments have been in technology. Just a little over a year ago, we closed the deal of a $2 billion investment to grow our tech business and become a leader in the precision ag technology for the mixed fleet, essentially all brands of equipment, not only our own equipment. So we've got a strong market that's stable, plus a market that appreciates technology in the area where we're really trying to focus and grow.
And Eric, I got to ask you, of course, about that political environment, right? Because we just got an agreement, it looks like, between the U.S. and China for China to resume purchase of soybeans. We've talked to some farmers here on Yahoo Finance who are really dismayed by the situation, by sort of that stoppage of purchases. So now that it seems to be opening up again, what does that mean for your customers? And have you already seen any kind of uptick in orders?
Yeah, I haven't seen any uptick in orders yet over the last couple of days, but we certainly see this as a net positive. There's two announcements that came out this week. Number one was the firming of the commitment of purchases from China of U.S. soybeans, largely 25 million metric tons. That's great. That's back to about normal levels of purchases. I think China had held off to create leverage in the trade discussions. But it seems like they're back in the ballgame. Now, we need to see that firm up and have those purchases actually happen. But there's a commitment of about 12 million metric tons yet this year. That's a great rate for the rest of the year. And then 25 for the next years after that. That's the number one thing that's going to give farmers confidence. In addition to that, though, there was a commitment by the U.S. government to provide more aid to farmers to help them with the issues that they've dealt with during the 2025 year. Farmers have really taken it on the chin by not only these purchases being down, but their costs going up. And so government support was announced that would be over $10 billion. So the combination of those two are certainly net positive for the U.S. farmer.
Well, and you talked about the sort of farm cycle bottoming, right? What effect did that sort of pause on soybean purchases have? Did it extend it and make it worse? And is it going to help sort of juice things out of it, be a catalyst to get out of it?
Yeah, let me give you a couple numbers. The U.S. large ag equipment market was down 30% this year. Our production was down 50% because we were trying to take inventory out of the system. If you compare our production levels this year compared to 2 years ago, we're down over 70%. So it's a dramatic drop-off in North America, partially because of the cycle, but turbocharged in a negative way because of the uncertainty and the lack of purchases from the number one consumer of export grain, and that's being the China market. So all of this hit at the same time. It was a pretty dramatic impact on the U.S. farmer, took their sentiment down. The average age of the fleet in the U.S. is getting older, and so there's a thirst to buy. And I'm hopeful now that with some of these indicators that came this week that will bring confidence back into the U.S. farmer.
Eric, there's something else I wanted to ask you about on the political front, and that's the so-called right to repair. That is, if I'm a farmer and I buy a tractor from one particular vendor, there are some vendors where it's very difficult for me to go and fix the tractor myself or to go to an independent dealer and get it fixed. And state by state, there's been some legislation around this. But now on the national level, Congress has introduced some legislation around this. Where do you guys stand on right to repair, and what do you think the outcome of that national legislation is going to be?
Yeah, we've been super clear on this from the beginning. It's the farmer's tractor. We want to help them repair it however they want to do it. If they want to bring it into the dealership, we'll take care of it for them. But if they want to do it on their own, we'll provide the tools and the repair parts, access to the repair parts to do essentially 98% of the repairs. There's a few things that we hold back that are safety related or emissions related, like emissions on the engine controls, software controls, and braking and steering, things like that. But farmers don't repair those type of things. So, but everything else in terms of hydraulics and mechanical issues and even electronic issues, they can buy the diagnostic tools from us, they can buy the parts from us and do the repairs however they choose to themselves or from a third party. So we've been very supportive. We've been working with industry associations like AEM to help craft language that is more consistent. What we would like is not a state-by-state environment. We'd like a national policy that kind of creates one playing field around the whole market. That's better for farmers. It takes the waste and complexity out of the system. But big picture, we want to help farmers repair their machines how they like.
And Eric, just quickly, does it also help you in a competitive environment? In other words, if this, if it levels the playing field for farmers, but also maybe for the manufacturers?
Yeah, we're trying to move from a reactive environment in terms of support to a proactive environment. So in one of our premium brand is called Fendt, and we offer 3 years bumper to bumper coverage of all maintenance and parts. So oil changes, filter changes, everything like that. And we remotely monitor those machines. So our whole notion is we're going to remotely monitor your machine. We see that it's coming up on a 500-hour service interval, or we're seeing error codes coming out of repair. We'll call them and say, hey, next Tuesday it's going to rain. How about we come out and take care of that for you? Farmers are great. Let's do it. As we show them the convenience and the ease of doing business with us, they actually like that mode. And so that's more our focus is moving from reactive to proactive, doing it for them, doing it right on the farm. We call it Farmer Core, where we come out and do all the work on the farm instead of having the machines having to come into our service base. So those combinations are where our focus is, and the farmers that use it have liked it. Our net promoter score is at an all-time high rating right now. That's our farmers giving us a score of how do they like doing business with us, all-time high in the history of the company.
Eric, great to see you. Thanks so much for joining us.
Always good to talk to you, Julie. Thanks a lot.
Thanks. We'll be right back. Investors have looked at Meta's results and they've said, well, the AI is working. Ad sales are up, and they're using AI in their business. Why was that not the reaction this time?
Yeah, and maybe just to lay out like the simple formula of why these will work or not work, there's kind of like three things they have to do. Number one, they have to show how the core business is working and funding these investments. And if you have AI as a part of that, which both Google and Meta do, that's great, right? So, but you need to keep beating expectations. The second one is you have to give investors a view and a vision for what these products and what these investments, frankly, can produce in the future that's not present today in the business. Google has given, I would say, a crisper or more substantive view, more likely view of success in that. And then the third one is obviously the spending levels and taking those up. And so with Meta last night, the key issue was the Q4 guidance came in a little bit soft, and it wasn't a lot. And honestly, they'll end up probably beating, we think, Q4. But the numbers are the numbers, and when you're raising spend that much and you're not giving people a vision that they really believe in on Meta AI or Vibes or any of these new things, it just makes it hard. That's why the stock's getting kind of killed this morning.
So let's take that vision part of it and dig into that a little bit, Brad. What is it about Meta that is not convincing investors in terms of that, like, this is what we're doing with this in the future?
Yeah, totally. And they talked about, when or if they see a paradigm shift. The way we frame it is that, Google adding AI overviews and AI mode and Gemini is really kind of a natural extension of search, right? Like we're all learning how to use this stuff. It's prompting new questions and new things we're asking for it. With Meta AI, I think you can make the argument that is a kind of totally new realm of utility, right? That people haven't looked to Facebook or Instagram to before. And so there's a bridge to cross there for Meta. And that's not to say the product's not going to be good, right? They have the super intelligence labs working on sort of making the model, they use the word novel, right? Which means differentiated from ChatGPT or what AI overviews or AI mode might look like on Google. But they're not there. And I think investors are sort of struggling to understand how they will get there because we just haven't seen the product. It's not in existence technically at this point. So that's kind of the issue. And to your point, with Google, it's there. You Google stuff and it comes up and it seems to be working. And they also saw, the Gemini app with 650 million monthly users, was that also a surprise? And how important is that for Google to keep on growing that? Yeah, the Gemini app certainly matters a lot, and that's kind of the direct comp to ChatGPT. So all good on that front. I think the incremental data point last night was the 75 million daily active users on AI mode, which they really only rolled out maybe like 5 or 6 months ago broadly to the US and Europe. That is super important because I think, for some of the early adopters and the hyper users of these, they will use, the ChatGPT app or the Gemini app, for example. But for kind of the broader masses, I would say AI mode is probably going to be one of the first introductions people have to generative AI. And the fact that that's starting to grow very, very quickly is a really good signal, I think, for Google. What does that tell you about these concerns that people are going to just be going to ChatGPT, for example, and not Googling anymore? Is it still going to happen? Maybe it just pushes it further off? I would say right now there's the fact pattern and the data points that have come out lately just do not support that view. That's not a knock on ChatGPT. Their growth continues. The adoption of that is still going really well. I think from a Google perspective, though, there's just clear evidence of incremental searches that people never would have done in a sort of traditional search environment. And if you continue to do those, there's going to be a portion of that mix that is very commercial. And Google is set up with 15 million plus advertisers to monetize that immediately. And that's what they said last night. It's already contributing to the growth of the search business. So there it is. Brad, I want to ask you a bigger picture question on spending. Obviously, all of these guys are still increasing spend. They still expect to increase spend next year. Like, how far are we from a peak in CapEx on this, or you can't even see it? Yeah, I don't even think that's the $1 trillion question at this point. That's like the $10 trillion question. I mean, nobody knows, right? Like, I think, and last night sort of added to that uncertainty using Meta as the example, because like I said earlier, the revenue guide was not as good probably as people were hoping for Q4, which is necessary, again, for investors to continue underwriting these investments. And yet, Mark took up the CapEx guide arguably in the order of $15 or $20 billion. So, well in excess of $100 billion a year now. So they're not even showing, in that case, they're not even showing sort of a sensitivity to revenue being tied to CapEx, which means that it could go up, indefinitely. So yeah, we don't have an answer there.
Happy Halloween, although maybe it's not so happy when it comes to how much you're spending on candy this year. This week, Hershey warned of disappointing Halloween sales due to a variety of factors, but the candy giant did boost its forecast amid its decision to raise candy prices by double digits due to high cocoa costs. Let's dig into the price of a bag of Halloween candy because it is indeed rapidly outpacing inflation. Here you have the average price of a bag of candy according to various sources here. And basically, we've seen about a doubling over the past 5 years. I know this because I am very stocked up on Halloween candy. A lot of people come to my house, but this also means, I don't know, maybe if you go to somebody's house this year, you're just going to get one little bar instead of take two, like is usually the rule at my house. Yes, we don't do full size, but we do give people multiple candies. So really, we have seen this incredible increase. And guess what? You're going to expect to see it at Thanksgiving and at Christmas as well. So, but have fun out there. Yes, it's about the candy, but it's also about dressing up. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance coming up.